Let's say you bought a house about 6 years ago. Nice place, quiet street, nothing fancy. You called an agent, you got a homeowner's policy, and you've barely thought about it since. It renews, you pay it, life goes on. But the house you insured 6 years ago isn't the house you live in today. You put in a pool, you added a diving board a couple years after that, the kids got a trampoline, and last spring you went solar. 4 real upgrades, 4 things that made your home better. And if you haven't spoken to your insurance agent about these 4 changes, your agent doesn't know about a single one of them. Every one of those 4 changes does something to your insurance, and you'd much rather find out what before you have a claim. If you don't know who I am, my name is Jim Eddington, and my agency helps individuals and businesses with their insurance every single day. Start with the pool, because it's the change most people are proudest of, and it's the least likely to be reported. You dig it, you fill it, and you enjoy it. You don't call your insurance agent because why would you? It's a pool, it's not a car. But a pool changes your risk in 2 directions at once. The first is property. That pool, the decking, the equipment, the fence around it, those are structures on your property, and a lot of policies treat them under other structures coverage. If a storm or a covered event damages the pool and your policy never accounted for it, you can find out at claim time that the number doesn't stretch far enough. The second direction is one that really matters, and that's liability. A pool is what the legal world calls an attractive nuisance. It draws people in, especially children, and that raises the odds that someone gets hurt on your property. If a guest is injured or worse, the claim doesn't care how much you paid for the pool. It cares about your liability limit. And the homeowner who never mentioned the pool is often the same homeowner carrying the liability limit they picked 6 years ago, before any of this existed. A serious pool injury can generate a claim that runs well past the liability limit on a standard homeowner's policy. When the judgment is larger than your limit, the difference doesn't disappear. It comes looking for you, and that can mean your savings, your other assets, even future income. That's the exposure most pool owners never see coming. So the pool isn't the problem, the silence is. When we know there's a pool, we can look at whether the liability limit still fits, whether the property side is accounted for, and whether it's time to talk about an umbrella policy that sits on top of the homeowner's limit and gives you another layer when a backyard accident turns into a 6-figure claim. We've covered umbrella in detail in another video on the channel, and a pool is one of the clearest reasons to have one. Now let's talk about diving boards, because that sounds like a small thing. It's a piece of equipment you bolt to the edge of a pool you already have, but to an insurance carrier, a diving board is not a small thing at all. Carriers track diving boards specifically, along with slides and certain pool configurations, because they change the injury picture. A pool is one level of risk. A pool with a diving board is another. Some carriers will write the pool without blinking and then have a real problem with the board. Some will write it, but want specific fencing, specific depth, a self-latching gate. This is where the not tell anyone habit turns into an actual coverage problem. When you apply for a policy or at renewal, the carrier is relying on what they know about your property. If the board went in 3 years ago and nobody updated the file, the carrier is pricing and underwriting a backyard that doesn't match reality. Carriers can take the position that the property they priced and approved is not the property they were actually insuring. The fix is almost boringly simple. You tell your agent there's a diving board. We find out how your specific carrier treats it. If your carrier doesn't like it, that's something we'd much rather know on a quiet Tuesday than the day after an accident. A trampoline is one of the cheapest things you can put in your backyard, and one of the most likely to get a homeowner's policy non-renewed. You can buy one for a couple $100s at a big box store, set it up in an afternoon, and have absolutely no idea you just changed your insurance situation. Trampolines are another attractive nuisance, and the claims history behind them is bad enough that many carriers have firm rules. Some carriers exclude trampoline-related injuries entirely, either through policy language or underwriting rules, meaning the trampoline is there, but a claim tied to it may not be covered. Some require safety netting and padding, and some simply won't renew a policy once they find out there's a trampoline in the yard. Picture how that plays out. A neighbor's child is jumping, comes down wrong, breaks an arm. Now there's a liability claim. The carrier investigates, and in the course of that investigation, they discover a trampoline that was never disclosed and that their guidelines exclude. You're now potentially looking at a denied liability claim and a non-renewal notice in the same month over a piece of backyard equipment you forgot was even an insurance question. And the timing tends to be cruel. Carriers often don't find the trampoline until they're already looking at your property because of a claim. The thing you never mention surfaces at the exact moment you need the coverage most. That's the pattern with all of these backyard items, and the trampoline is where it shows up most often because it's so easy to add and so easy to forget. I'm not telling you to get rid of the trampoline, but I am telling you that a 2-minute phone call lets us check whether your carrier allows it, what they require if they do, and whether you're better off with a carrier that handles it differently. Some carriers are far more comfortable with trampolines than others, and an independent agency can move you to one that fits. Solar is the newest of these 4 upgrades and in some ways the most complicated because how it's covered depends entirely on how it's attached and who owns it. If you own the panels and they're mounted to your roof, they're usually treated as part of the dwelling, which means your dwelling coverage amount may need to be high enough to rebuild the house and replace the system. A rooftop solar system can add a serious amount to your replacement cost. If your dwelling number never moved when the panels went up, you could be underinsured and not realize it until you're trying to rebuild after a fire. Ground-mounted panels are a different conversation. Detached from the house, they often fall under other structures coverage, which has its own limit, and that limit may not be anywhere near the cost of the array. And if you lease your panels or you're on a power purchase agreement, you don't own the equipment at all, which raises questions about who insures what. That's a detail your agent needs to know because leased and owned systems are not handled the same way. There's also the roof itself. Installing panels means putting penetrations in your roof, and that can intersect with how a carrier views your roof's condition and age. Some carriers look harder at a roof once there's a system mounted on it, because the panels complicate a repair or replacement after a hail or wind event. If your roof is already on the older side, adding solar can become one more factor in an underwriting decision. We've talked about roof age and non-renewals in another video on the channel, and solar sits right alongside that conversation. None of this is a reason to avoid solar. Plenty of homeowners across our states have gone solar and it's worked out fine. It's simply a reason to make sure the policy caught up with the panels. When the system goes in, that's the moment to confirm your dwelling number moved, your carrier knows whether you own or lease, and nothing about the install created a problem at your next renewal. Step back and look at these 4 together. A pool, a diving board, a trampoline, a solar array. They have almost nothing to do with each other except for the one thing that matters here. In every single case, the homeowner improved the property, and in every case, the carrier had no idea. That's the actual risk, not the pool, not the board, not the trampoline, not the panels. It's the gap between the home you're living in and the home your policy insures. Insurance is priced and underwritten on information. When the information is current, the carrier can charge the right premium, set the right limits, and pay the right claim. When the information is 6 years stale, you're carrying a policy built for a house that no longer exists, and you usually don't discover the difference until the worst possible moment. And carriers don't actually wait for you to tell them anymore. They can pick up these changes through property inspections, renewal reviews, aerial and satellite imagery, or a claim investigation. So if something on your property changed, it's far better for your agent to hear it from you first. Here's the practical takeaway. Anytime you make a real change to your property, you add something, you build something, you put something in the backyard, that's the moment to make one call. If it's been a few years since anyone looked at your homeowner's policy and the house has changed since then, that's worth a conversation. We work with homeowners across Nevada, Arizona, Utah, and California, and we can look at your current coverage, find the gaps, and shop it across multiple carriers to make sure the policy matches the property. The link to get a quote is below, and if you found this useful, subscribe to the channel. We publish most business days, and what we cover is for individuals, families, and business owners who want to understand their insurance before they need it, not after. Thanks for watching.